This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading.
Good afternoon, traders. I'm Scott Norris here, wrapping up the week. Today is Friday, February 23rd, 2007. The dollar struggled this week in the broad market, able to gain only against the very weak Japanese yen. The buck did not start off the week on a very bearish note, but today's sell-off has really hurt the currency technically. This week's economic calendar was very light, which may have left traders pondering last week's string of dismal reports from the U.S. CPI was the most important data this week, which did come in a bit hotter than expected in the core readings. Key data from other G7 economies included the BOJ rate decision, Canadian CPI and retail sales, Bank of England minutes, and German IFO. The Bank of Japan's rate decision early Wednesday morning may have been the highlight of the week, as economists were split right down the middle with expectations. The BOJ did hike rates to 0.5%, but quickly threw cold water on the surprise move by stating that further moves would come very gradually. The yen has since found great weakness rather than strength on the back of the increase. Canadian data came in very hot, and along with higher oil prices, has pushed the Canadian dollar sharply higher. Bank of England minutes were a disappointment to some traders, as the report showed a vote of 7-2 to keep rates unchanged at this month's meeting. This hurt the pound sterling only temporarily, however, as we have since seen a nice rebound. Lastly, German IFO numbers came in just a touch lower than expected, but have not been much of a hurdle for the euro today. Now to the big picture. For now, it appears as though the carry trade may carry on as investors continue to use the yen to fund investments in other currencies. The Japanese yen came under heavy fire again this week in the face of a rate hike from the BOJ. The reason that traders responded this way to what should have been a yen positive is really two-part. First, the fact that many were hoping for a rate hike in January and felt that the Bank of Japan caved to political pressure to leave rates unchanged. The second part is that the BOJ said any further action will come very slowly, and most see the government keeping the pressure on strong from here. This could allow dollar-yen and several yen cross pairs to continue higher in this seemingly one-sided market. Any fresh data out of Japan that helps confirm government fears will only increase the intensity of such a move. Many firms have suggested in recent days that they are still on board with carry trades using the yen and believe the fundamentals support such a move. The charts indicate that many market participants agree at this point. Of course, we cannot stress enough how cautious traders should be in protecting the downside, as these trends remain incredibly overextended. Till next week.